In this session, I'm going to take a look at how you go about developing a trading strategy. I will look at an oscillator strategy and then take that into a mean reversion strategy. So I'm going to go through sort of key principles, so how you set about selecting your entry criteria, your exit criteria, and managing risk, so a strategy for stopping out of a position if the trade moves against you. So to begin, I will first of all, I'm going to create a simulated trading account. So we'll call this webinar. And I'm going to focus on FX strategies. So I'm going to change this to a simulated FX account. Okay, after a portfolio has been created for testing, you can click on the Trade tab to open up a chart. So for this example, I will just go with the first chart that opened, which is the pound dollar GBP USD. And the first thing I will do now is add some indicators. I will set about developing a strategy. So I'm going to use something simple like the RSI, which is a popular one. So go to chart settings, search for RSI. So you have over 100 indicators to pick from here. So we've added RSI, so we'll start developing a strategy around it. If you look at a 1 minute chart, the classic theory with RSI is RSI below 30, RSI above 70 to buy sell. One of the challenges with that is that when it's a bullish market, the market's going up, you don't tend to get RSI. If you look at this period where it's going sideways, RSI didn't get down below 30. So RSI below 30 and above 70, it tends to only work effectively when the market is going sideways. When the market's going up, it doesn't get down below 30. When the market's going down, it doesn't get up above 70. So what we'll do is, before we get into analysing that, what we'll do is when developing a strategy, the first thing is to look for a correlation between the indicator and the price action that you want to trade. So if we look at this chart, places where we'd like to be buying are down here and selling up here, buying, selling. So you try and find a correlation between the indicator and the price action. So in this case, we'll start off with simply going through different interval periods to see when the high of the RSI aligns. So I'm switching now to a 3 minute. You can see with the 5 minute we're starting to get some correlation with lows and highs. We'll just try the 10 minute. Okay, there's decent correlation here with highs and lows. We'll just try the 15 minute. It's not bad as well. Okay, we'll work with the 11 minute or the 10 minute interval RSI, with the theory that we're trying to buy on these sort of lows, sell on these sort of highs, and just keep switching from long to short to long positions. So as I started saying earlier on, one of the challenges with RSI is that if you listen to the textbook, it says RSI below 30 is when you buy. But if you look at this bullish move, RSI got down to 38, got down to 34. So you didn't get any entries during this bullish move, and you only started to get the entries at the end of the move when the move's over, so down below 25. So if your strategy was based on buying below 30, when you want to be buying is when the market's going up or sideways, you don't get any entries. So a solution to this is to look at the trading range for the RSI. When I say trading range, what is its relative high and low? So rather than just use static levels, dynamically look back and say, okay, over the last hour, day, whatever your time frame is, what was the lowest RSI value, and then as the market's going up, you adapt to it. So we will build a custom indicator that will look for the lows, the RSI highs and lows that we're going to trade. So the first principle in developing a strategy is try to avoid, if you're using an oscillator type approach, try to avoid static levels. Adapt to the market if it's a bullish market or a bearish or sideways market. And for this we're going to look at the relative highs and lows for the RSI. Okay, so I'm going to subtract. I'll explain this more in a moment. I'm going to get the highest RSI value. Okay, so it said give me the highest RSI over the last, well, we'll come back to that in a minute. I'm going to subtract 2 from this because I want to pull it in because I'm looking for a crossover. So we'll just rename this and I'll explain it more as I go. So I'm just calling this indicator high RSI and we'll just drag it down. Okay, onto the RSI chart and I'll give it a different color so it's a bit more obvious. Okay, I'll repeat the process now on the other side. This time I want the lowest RSI value. And we'll say 2 again and then change the color and we call this low RSI. And we'll drag this down below. I'm going to make these colors a bit more vibrant. So hopefully you can see them a little bit better. We've now got 2 sets of lines, but right now all this is doing is forming a channel. What we want to do is look at the typical time it takes to go from one low to the next. So if you look at the time stamp here, it went 1500 hours through to 8 o'clock the next morning, so that's 8 hours plus something like 9 hours. So we'll say we're looking about at least 10 to 15 hours. So go back here and we'll change the amount of data that's been used. So we're on a 10-minute chart. So if I go 6, that means 1 hour. So if I go 60, for example, that is 10 hours. So we'll start off with, say, 48 hours. Or 48 10-minute intervals. So if you can see in the chart below, you can see the bottom line. It's looking back and it's using this low as a reference for 48 hours, and then it starts to readjust to the directional movement. So for example, when the market was moving upwards, you were picking up the trades here, you're getting potential entries. Okay, so the objective of this is to use dynamically adjust to the trading range of the market. So if the market's going up, then you have to raise your level where you enter. And if the market's going down, and again you lower your level. So we'll use these to get started. So now what we'll do is we'll create a simple strategy based on buying when the RSI falls below the lower band, and then selling into a short position when it rises above and falls below this band. And we'll see how we get on. I'm just going to save these settings. To build your alerts, you can use the alert triggers in the bottom corner of the chart. So in this case we want the RSI, if it falls below the low RSI, we've added a simple rule. And now what we're going to do, you can use time to trade now just to get an alert sent to you by email, etc. In this example we will set up a trade, and what we're going to say is if we have a short position, then we're going to close it and then buy into a long position. So if it comes down here, we want to switch from a short position to a long position. We'd say 100k or $10 a point. We'll leave out the stops and losses, so limits and stops for now, because we're going to sell if RSI gets the other side of the range. I'll just leave this as it is for now, and we call this switch long entry. And we want it to keep happening over and over again. So we want this to happen when the RSI falls below the lower range and then rises up. So if we zoom in and take a closer look here. So we're looking for these sort of events where it falls below, and then on the rising edge we're going to enter a position. So we just pause that, and now we'll create an alert whereby we want to test if it rises above and then falls below. We'll use that as the exit. So select if two lines crossing, the RSI must drop below the high RSI. I'm going to keep it simple enough. So this time, if we have any long position, we want to close it and then sell into a short position. I will just leave that as it is for now and test it. Okay. So what I've said is if the RSI falls below, we're going to close any long position on the K and then switch into a short position. So that means we'll keep switching from long to short positions, and we'll just hit pause. So now we have two rules. We just go and test them and see how we're getting on. Click on back test at the top, select your two alerts, then select back test. Okay, so first of all we get a summary of how much we made when we got it right, when we won versus loss. So we made $328 in this case versus $317 loss when we got it wrong. It tells you the ratio here of win to loss, so 83% of the trades were winning trades, and it gives you an indication of the overall performance, etc. And here we have a total profit. So if you take a look at this on the chart to see what's going on, to see if we're happy, click on the view details. So this blue chart gives you an overview of your cash position over time, so it's generally quite positive. You have a breakdown here of your drawdown, etc. And you can see here a list of the trades that were executed. So let's take a look at the chart. So we'll zoom in here. So a down arrow is a sell. I'll just zoom in here. As good as anywhere, yeah. So a down arrow is a sell, an up arrow is a buy. A grey arrow indicates an opening position. A green one indicates a profitable sell, and if we can see any blue ones, a blue ones means a trade that made a loss when you were selling. Now if you look at this, you'll see that there was a lot of trades accumulating. So we had one opening, two opening, three, four opening positions in a row. And if you're trading, you may not want to continually build into a position. You may want to make one or two trades, but you typically don't want it to trade indefinitely. So what we'll do is we'll go back to our alerts and we will edit them to allow us to control the quantity that we're going to buy. So click on the alerts, then the edit button, and go back into the deal ticket. So we leave the stops and limits, and this time what we'll say is if no position, or in this case what we're going to do is close long positions. So we'll say if no position or long, and we can set a quantity. If the quantity is any size, or if the quantity is less than 250k, for example, you can set it up to whatever you want, and that means every time the alert conditions are met, it will buy until if the existing open position quantity is less than 250k. But for now, what we'll say is very simply, if no position or long, we want to execute that. So that means if we are in a long position, we want to close it and then sell into a short position. Okay. And pause that, and now go to the other one. So what I'm saying here, if we have no position open, so at the very start we'll have no position, or if we're short, we want to close the trade. So now we'll back test that. So remove the other one. So now obviously we made an awful lot, we made less trades, therefore less overall profit. So let's take a look at the chart. So if you look at the chart now, there was one entry trade, then one exit. So that meant when that position was opened, so the switch trade, the short switch trade, when it opened, it was only allowed to execute a trade if it had no position or if it was long. So when that opened a position, it sold into a short position. So that meant each time that the alert triggered thereafter, it didn't fire because it had a short position. It didn't have no position and it wasn't long. So that allows you to control when you make a trade. So if we glance at this, the green arrows, there's plenty of green arrows. We can see that maybe a little bit early getting into this one. That was quite good. Now one of the weaknesses here with this strategy is that if you get strong directional moves against you, so we zoom in here and have a closer look. For example, here we sold and then there was strong directional moves against us. We were lucky enough that there was a recovery, but it could have hurt us if it had have continued to run. So what we do now is we look at how you would go about developing a strategy to, for example, to stop that from happening. So I'm going to do something quite simple. I'll just use for this, I'll use a Bollinger Band, something quite simple. So we'll say, okay, I'm going to add a Bollinger Band, so I went to the chart settings, and I want it on 3 deviations. So basically, if there's a strong directional move, so 99% of the movement for the last 20 periods was within these bands. So if there's a strong directional move, I'm going to stop out of the position. So hit Save Settings. So now we'll set up some rules that will exit if we sell into a position and it breaks through an upper Bollinger Band, or if we buy and it breaks through the lower Bollinger Band. So what we're going to do now is create more alerts that says if the close price, well, shall we say the high, rises above the upper Bollinger Band. And you have a choice to make now. You can say check this at the end of the interval. So if there is a strong directional move, you'll wait until the full 10 minutes is played out before you stop. But if you wanted to check this during the interval, so at every tick, you would select this option. But for now, we'll just say if at the end of a 10-minute interval, if the high price, or should we say the close, if the close price is above the upper Bollinger Band, then we want to stop out of any short positions that we have. So what we'll do here is we'll just say close position and only execute that. So if the price breaks through the high that we've sold, we only want that to execute if we're short. And now we call this stop short exit. So to recap, if you zoom in here, if the price punches through the outer side, we're going to close only if we're in a short position. Okay, so we sold into a short position here, we want to get out here. And we'll set it up as ever to repeat. So I'll create an alert for the other side. So if the close price drops below the lower Bollinger Band, we want to close the position, and this time only if long. So we're looking for a scenario where we bought, for example, we bought and then the price breaks through the lower Bollinger Band. Okay, hit pause. So now what we'll do is we'll go back and we'll now back test this with the extra rules added. We've now got 4 rules running, 2 Bollinger Bands and the 2 entry rules. Okay. So now with the stop, you can see that it was clipping you in and out of some positions. So you can see at the start, if you compare to the previous one, So this one did take a few moves, but one of the problems that we can see that we've introduced now is that the stop is clipping us out of some perfectly good position. So let's take a look at these on the chart and see what's going on. So you see we've introduced a lot more blue arrows. We zoom in here. So one of the problems that we have at the moment is that we sold, the price broke through the upper Bollinger Band, it closed the position, but then it sold again. So one of the things you can do is to prevent it repeatedly buying, go back to your original alerts, click edit. So rather than restarting a minute later, change this to, for example, 1 hour. So when your entry conditions are met, don't try and buy again for at least another hour. Okay, so I've changed it now that after you sell, it will not attempt to sell again until 1 hour has passed. So we'll go back and retest that. If you note here, it didn't try to re-enter until it fell below here. So it waited for an hour. So one of the lessons here is when developing the strategy, what you will find is quite common to find is the introduction of a mechanism for stops can result in false positives, as to say. It can cause you to stop out of positions that are perfectly fine. And one of the balancing acts you have to have as a trader is to have the balance between risk and getting the necessary performance out of your indicator. So we've talked a little bit about now how you can set about introducing stops to protect you. For the most part, the trading action was mostly sideways. There was some direction movement, so there wasn't a strong demand for stops in this sort of scenario. So you can see how that's why the performance was not just as good. However, when the price breaks hard in one direction, they do save you, and that's when they earn their worth. So what we do is we take this strategy. This strategy at the moment is primarily an oscillator strategy, looking for overbought, oversold. Another variation of it is to revert to the mean. So let me just clear off some of these indicators, and we'll talk a little bit about introducing mean reversion to this. So mean reversion, the principle of mean reversion is to identify an outlier event and then trade it back to the mean. So for the mean in this example, you can use a moving average or exponential moving average, something that you think you're looking for a fit. Let's go for an EMA 60. So in this case, I've got 10-minute candle, 60 candles is 10 hours. I think. Yeah. So in this case, we're going to use this line as the mean, and the ideal sort of setup we're looking for here is an outlier event to try and get in somewhere down here and then trade it back to the mean. Down here, trade it back to the mean. Up here, trade it back to the mean. That's the principle of a mean reversion strategy. And if you look at most of the successful traders, at least that I know, and strategies, you'll commonly hear this quoted as a methodology for trading. So for example, if you have somebody who's a value investor, they talk about buying something cheap and then holding it till it reverts back to fair value. That is mean reversion. If you look at trading, for example, of support and resistance levels, you're looking for reversion from an outlier event, a point of support or a point of resistance, back to the mean, and maybe you've overshoot to the other side. So we'll now set about testing this mean reversion strategy. So go back to our alerts, and what we'll say is, if we're in a short position and the price falls through the mean, we're going to close. So if the close price drops below the EMA, what we're going to say is close the position, and only execute that if I am short. So this is the short take profit strategy. So we'll call this mean short exit, mean reversion short exit. Okay, so close if short. So if the price falls below this line, we're going to close out the position. As before, make it reactivate after the conditions are met, start checking again. And then the other side of the coin is if the close price rises above, so we're going to close the price or close the position if we're long. So now we'll see how this performs. Tend to get more frequent trading. So we'll just add this into the mix and test it. Okay, so now with the stops, so beforehand with the stops we had a profit of 652, now we're up to 921. So let's take a look on the chart. Oops. So it's quite nice and steady. One or two bits at the start were hurting us, but then it's generally been quite steady. So if we have a look at what's going on here. So we sold, took profit when it broke through. We switched into a long position, reverted to the mean, so we waited for the close of the candle. You can see these smaller sort of trades. So because I'm running two sets of rules, what actually happened here was the price or the RSI fell below the lower range. We entered a position, and then it actually then fell below the upper range, so we closed the position into a short position and kept oscillating from side to side. When you are developing these trading strategies, you have to make a decision. Do you take the falling edge, the leading or the rising edge when you're entering positions? You can sometimes get a better performance if you're prepared to take more risk, if you take the entry when it punches through rather than falls below the outer range. So you can see, for example, here you would have saved yourself a couple of pips on your entry. However, the benefit of waiting is that if there is a strong directional move, so you would have entered here, for example, but by waiting you get in at a better price. So it's always that trade-off between the leading or the trailing edge when selecting which way to trade these outer boundaries. So now we have a strategy, and the key principles of the strategy of this are this. Or when you're developing a strategy, first of all, you focus your energies on trying to get a strategy, an entry point which has a reasonable amount of distance from the mean that you choose. So you're looking for an outlier event. You know, these aren't perfectly near the edge, and you would probably work to refine your strategy to try and get it closer. So you might change your interval, you might change the look back period from 48 hours to 60 hours, etc. We'll just go and quickly try that. So we'll go to, not hours, 60 candles, which is 10 hours in this case. And let's change that to 10 hours. Okay, this now becomes less sensitive to change, or requires a greater period of time to pass before it starts to adjust to the range. So we'll go and pause our, we'll go and modify our alerts to test this. Just check it through it, yeah. Or you can just click on the alert triggers on the chart and rebuild it from scratch. And now go and back test that to see if we can improve in the performance. Okay, a notable difference now, simply by being less sensitive. So rather than using 48 10-minute candles, we use now 60. And if we compare how it was, so on the right hand side, there's just nice, it was better performance. The key difference actually just came near the end, where we weren't in a losing position. So let's take a look at that on the chart. So again, down here, could work with some refinement. Back again to the mean. Okay, so your job as a trader now is to find chart conditions that give you a high probability of a reversal. So for example, as we said, RSI. So you go through the various indicators and you look to try and correlate it with the price action. So your starting point is select some indicators first of all. Secondly, step up and down through intervals until you get a better correlation or a good correlation with the highs and lows on the chart that you want to trade. When you've identified them, then you can set up your alerts to test your entry and then your exit. You then have to decide, are you going to try, if you're going for an oscillator strategy, you're going to try and trade it all the way back to the other side of the range, or are you going to take it in between and use a mean reversion? So get the outlier, as soon as it goes back to the mean, close out the position and wait for either a short entry or a long entry. So to close it off, then I'll just show you some other examples of what you can do with time to trade. So when you've finished testing your strategy, you can set up a simulated account, and then you can go then and just set up a live LTG or a live trading account and execute your strategy in the real world. And some of the advantages of the product is, hopefully, as you can see, there's no coding required. You can mix in and out manual trades while a strategy is running. So you just go to the deal ticket. At any point in time you can enter a trade. So you've got an interface for adding in your stops, your limits, a trade off the chart interface. You can also do things like, you can say I want this strategy to run as long as the price is above this trend line. So you can draw a trend line and you can say if the price falls below that, what I would like to do is close any position that I have, and then I want to pause all of my active alerts. So if these were all running, we just activate the alerts below. Okay, so on this test account I've hit my limit. So you activate your alerts to have them running in the real world, executing your trades, and then you can do things like, if for example the price breaks a trend line, you can then close your positions and pause all of these alerts. So that kind of wraps up this session. So if you have any questions, if you can put them into the chat. Alrighty, I'm going to wrap it up there. So thank you for your time, and my name has been Dary McGovern, Managing Director of Time to Trade. And if you have any questions, just go to the Time to Trade website. And at the bottom of the page there's a contact us link, so just click on contact us, and if you have any questions or you want to discuss your trading strategy, let me know and I'll do what I can to help you put it together. Okay, bye.